So, you're looking to build a really solid investment portfolio, right? Well, a US Total Market ETF is pretty much one of the best foundations you can possibly have. But here's the thing, there are three huge players that just dominate the space, and trying to pick one can feel kind of overwhelming. Is there a right answer? Let's dive into the data and find out. Here's how we're going to break it all down. First, we'll talk about what it even means to own the whole market. Then, we'll introduce the three big contenders before we put them head to head, comparing all the core stats and, most importantly, their performance. We're even going to run a 10-year case study you asked for to see how they've grown. And by the end, you'll have a super clear way to make your final choice. All right, first up, owning the entire market. Before we even get into comparing the funds, let's just quickly get on the same page about why this strategy is so powerful in the first place. So why even do this? It's actually pretty brilliant in its simplicity. Instead of trying to pick winning stocks one by one, a total market ETF lets you buy a tiny slice of pretty much every single public company in the US all at once. It's instant, massive diversification, and it's just a fantastic core building block for any long-term portfolio. Okay, with that foundation set, let's get to the main event. It is time to meet the three heavyweights that absolutely dominate this corner of the market. So our contenders are VTI from Vanguard, ITOT from iShares, which is run by BlackRock, and SCHB from Charles Schwab. Now, these aren't just any old funds. We're talking about products from some of the biggest, most trusted names in the entire investment universe. Okay, it's time to pop the hood and see what's really going on inside these funds. In this section, we're just going to look at the hard data, plain and simple.
So let's really focus in here because the key differences and, the similarities, it's all right here in the numbers.
You know what's so fascinating about this is how similar and yet how different these funds are. First, just look at that expense ratio. It is an identical rock bottom 0.03% across the board. Insanely cheap. But then you start to see the differences, right? VTI holds about 1,000 more stocks than the others, which gives it the absolute broadest reach. And then look at the assets under management, or AUM. VTI is just a monster at over $500 billion. So what even is an expense ratio? Well, think of it as the tiny annual fee you pay to own the fund. A fee of 0.03% means that for every $10,000 you invest, you're only paying $3 a year. That low cost is a huge advantage for long-term growth because it means more of your money stays in your pocket working for you. And what about AUM? That's just the total pile of money that the fund is managing for everybody. A higher number, like VTI's, usually means the fund is more liquid. Now, for most of us, that's not a huge deal, but it just means it's super easy to buy and sell shares whenever you want without affecting the price. And that brings us to the million-dollar question, doesn't it? With these differences in how many stocks they hold and how big they are, how does that actually translate into performance, for your wallet? So, after all that, which one actually performs the best? And the answer, which this quote from The Motley Fool just nails, is it's pretty much a dead heat. Yeah. Despite all those little differences under the hood, their performance tracks each other so closely that it is almost impossible to find any real, meaningful difference. And here is the proof in the pudding. If you put $1,000 in 5 years ago, you'd have $1,728 with VTI and $1,730 with ITOT. The difference is $2. $2 on a $1,000 investment over 5 whole years. For all practical purposes, they are identical. So let's zoom out a bit. Let's take this a step further and look at a longer time frame. This is where the real magic of this strategy starts to show. We're going to see what happens with a $10,000 investment over 10 years. All right, let's play a little game of what if. Imagine you put $10,000 into one of these funds a decade ago, and you just let it ride. You didn't touch it. What would it be worth today? Let's start with VTI. Based on its 10-year average annual return of just over 15%, your 10 grand would have grown into an incredible $40,616. That's the power of compounding in a super low-cost fund right there. Okay, and what about Schwab's SCHB? Well, its 10-year average is 15.02%, turning that same $10,000 into $40,535. I mean, again, the difference is practically nothing. Both of them delivered absolutely phenomenal and nearly identical long-term growth. So here's the crucial point, right? The choice between VTI or SCHB or ITOT is way, way less important than the decision to just consistently invest for the long term in a low-cost total market fund. That's the real engine that builds wealth. So if they're all basically the same, how do you actually make the final call? Well, in our last section here, we're going to give you a really simple framework to make your decision and feel great about it. Okay, since performance isn't going to help us decide what's the tiebreaker, well, for VTI, its edge is maximum diversification. If your philosophy is, I want to own literally everything, then those extra 1,000 tiny stocks give it a slight edge. For ITOT and SCHB, the main advantage might just be simple convenience. If you already have a Schwab account, it's probably easier to just buy SCHB. Simple as that. So let's just wrap this all up with the key takeaways. 1. All three of these ETFs charge a ridiculously low 0.03% expense ratio. 2. Their performance over the last decade is basically identical. 3. VTI gives you slightly more stocks if you're a fanatic for diversification. And 4, and this is the most important one, you absolutely cannot go wrong. There's no bad choice here. And that really leaves us with this final thought. The question you should be asking yourself isn't, which of these funds will make me more money? Because honestly, the answer is they'll probably perform about the same. The real question is, which one fits my personal style and my brokerage platform the best? Do you want maximum diversification or do you want maximum convenience? The answer to that question is your final verdict.